How's it going, guys? It's Average Income Investor. In this video, I wanted to go over my income portfolio. I had a few questions last week about the brokerage that I'm using. This is M1 Finance. I've been using it for 3 years. I've tried using Robinhood and Webull, but this is the brokerage that I prefer. I put a referral link in the description of this video if you would like to open up an account. If you set up an account and put $500 in it, we each get $50. With that being said, let's go over my goals with this portfolio. My goal with this portfolio is to create a steady stream of future income. I'm not looking at current yield, rather a strong history of dividend growth. I'm buying ETFs and companies that I believe will grow their dividend well into the future. Let's take a look at United Healthcare for example. Even though their current yield is only 1.26%, their 5-year average dividend growth rate is 18.71. Let's assume they keep their dividend growth rate the same for 20 years. A $100 investment today would only give you a $1.26 yield. Let's also assume the share price goes up by 9% year over year, and you reinvest the dividend. That $100 now has a yield on cost of 58.17%. In other words, your $1.28 dividend turned into a $58 dividend. This is the power of compounding dividend growth. This is the main mechanism that I plan on taking advantage of in order to retire. Now, as I get closer to retirement and have less time for my dividends to compound, I will be switching my focus to current dividend yield. Now, taking a look at my portfolio. If you've seen my last video, this might look somewhat familiar as I have 40% of my money going into ETFs. I would always recommend putting the majority of your money into well-diversified ETFs. This just ensures that you don't get in the way of your own investing goals. It's very easy to get ahead of yourself in the stock market and start taking more risk than you can handle. ETFs are a good way to hedge against yourself in case you end up buying stocks that just don't work out. Now, clicking on my dividend growth ETF, you can see that I have it broken up evenly into 4 different ETFs. The first one on the list is Noble. What Noble does is it invests equally into all of the dividend aristocrats in the S&P 500. Dividend aristocrats are companies that have been growing their dividends consecutively for 25 years. Next, we have SCHD. This is probably my favorite dividend ETF. It has a great combination of current dividend yield as well as a pretty impressive 12.32 5-year average dividend growth rate. SCHD only picks stocks that have been paying a dividend consecutively for at least 10 years while also taking other factors into consideration. Third on the list here is DGRO. This ETF has a slightly slower dividend growth rate and a moderate current yield. DGRO only looks for a 5-year dividend growth history while selecting stocks. This allows it to buy newcomers that may be the future dividend aristocrats. Last but not least, we have DGRW. While all of these other ETFs look at past dividend growth, DGRW looks at companies that have the highest potential dividend growth in the future. It does this by looking at a company's dividend growth as well as the payout ratio. A payout ratio is the percentage of earnings that a company pays out in dividends. A low payout ratio indicates that a company has room to grow their dividends in the future. Moving on to my individual stock picks, we see that I have 15% going into M1 Cashback. Now, this is something that I definitely do not recommend you copy without due diligence. All of these companies allow me to get cash back with my M1 credit card. That being said, I have done research into each of these individual stocks, and I would have no problem owning them if cashback was not an option. My favorite of these would have to be Target, Lowe's, Domino's, Home Depot, and Starbucks. All of these companies have really great dividend growth histories, most of which have grown their dividends upwards of 15%. Next up, we have healthcare, which makes up 15% of my portfolio. I have this broken up into 5 different companies. 35% goes into United Health Group. As we heard earlier, this has a stellar dividend growth history as well as a very low payout ratio, as you can see here. This is a company that I'm extremely excited to own more of as the price continues to drop. Next up here we have Stryker, which makes up 25%. This is another stellar dividend growth healthcare company. Stryker is actually a dividend aristocrat with a dividend growth of 27 years as well as a 10% plus 5-year average growth rate. DHR makes up another 25%. This company has the fastest revenue growth of all of these healthcare companies, with its dividend growth still an impressive 11% 5-year average. Next up here we have Johnson & Johnson, which makes up 10%. Now Johnson & Johnson is legendary among the dividend growth community. It is actually what you call a dividend king. It has grown its dividend for over 50 years. The drawback is, as it is such a large, well-established company, its 5-year average dividend growth is only 5.87%. This makes it the slowest growing dividend rate of my healthcare slice. Lastly, we have Pfizer, making up only 5%. Pfizer has the largest current yield of all of these companies, with a still impressive 6.5% 5-year average dividend growth. Next, we have my finance slice. This makes up 13% of my portfolio. Now, 25% goes into Aflac. This was actually a purchase I made after analyzing the value of Aflac about a month ago. I noticed that the company, which has a stellar record of dividend payments and growth, was selling below its average price to earnings ratio. It's still slightly below its 5-year average PE ratio, but as you can see, its price has gone up since I bought it a month ago. Now, MasterCard and Visa make up 20% of my finance pie each. These companies have a sort of duopoly on the debit and credit card manufacturing industry. They each have a stellar dividend growth rate of nearly 18% on average. They are slightly overpriced, but I believe they have a lot of room to grow their dividends in the future. Now, currently, T. Rowe Price makes up 15% of my finance slice. Recently, this great company that has 35 years of dividend growth has sold off drastically. If this sell-off continues, I will consider making it my largest holding in this slice. Discover is another financial company that I consider cheap right now. They're a great dividend payer, and I personally like their products. JP Morgan makes up the last 10%. Before I restructured my portfolio, I had a larger holding in JP Morgan, but after I restructured, I decided to make faster dividend growers be weighted higher in my portfolio. That being said, I still see it as a great company with great dividends. If we back out of here, we could see that I have 5% going into real estate. This is still a work in progress, as you can see a few of these companies in here don't have any money invested into them just yet. And if you watched last week's video, I go over most of these companies in depth. My value fund is something that I just started the other day. Eventually, it'll make up 10% of this portfolio. All of these companies in here, I believe, are priced below what they are worth. My goal is to buy while they are low and eventually sell while they're high. Honda and Smith & Wesson are the most undervalued out of these 5 in my opinion. Lastly here, we have my income ETF, which makes up a measly 3% of my portfolio. This is split up into 2 different ETFs. JEPI and NUSI, respectively. These are both covered call ETFs. They have a substantially higher yield than the market average at 6.72 and 7.53. Right now, they only make up 3%, but as I get closer to retirement, I will fund these more aggressively in order to live off of the dividends. That's all I have for you guys today. If you enjoyed this video, remember to leave a like and subscribe. Thanks for watching.